In this video, I'll be revealing why 57% of retirees regret retiring too early and the critical mistakes that create this devastating regret. Through analyzing early retirement failures, I've discovered that the problem isn't early retirement itself, it's poor planning. That's exactly why I'm making this video today, to show you the specific mistakes that create early retirement regret so that you can avoid the most common pitfalls. If you're new to this channel, I'm Cody Gunn. I'm a CFA charter holder and the founder of Arrowstone Wealth, where we help clients retire early through smarter investing and lowering their lifetime taxes. And with that, let's get right into it. Okay, the first most common landmine in the retirement landscape is what I call the cost underestimation trap. It is the simple but brutal reality that life in retirement often costs a lot more than people budget for. Many successful people spend their careers meticulously managing multi-million-dollar budgets at work, but then use some back-of-the-napkin math for their own 30-year retirement. So what costs destroyed the early retirement dreams of 57% of people? First, and this is the biggest one, healthcare. While you're working, your employer-provided insurance is like a massive invisible subsidy. When you retire early, before you're Medicare eligible at 65, that subsidy completely vanishes. And suddenly, you're looking at full sticker price. It's not uncommon for these healthcare costs to double or even triple for an early retirement. The second problem is inflation. We've all felt it recently, but retirees feel it more acutely. Why? Because a larger portion of their budget goes toward non-discretionary items, groceries, utilities, property taxes, things whose prices tend to rise faster than headline inflation. Inflation is like a silent partner in your retirement. It takes a bigger and bigger cut of your income every single year. The third problem is your home. You'd think that while being home more, you could keep a better eye on things. But ironically, the opposite tends to be true. You start noticing the deck needs restaining, the HVAC system sounds funny, and the roof is quite frankly looking a little mature. Home maintenance and repair costs often increase when you're home more often because you're there and you're more aware of the slow, expensive march of entropy. So why does cost underestimation create such a devastating regret among early retirees? Because it's a problem that compounds. Those rising costs force retirees back to work, often in jobs they don't want, or into lifestyle restrictions they never imagined possible. That dream of traveling the world becomes the reality of watching the Travel Channel at home. Cost underestimation destroys budgets, but savings overestimation creates an even more dangerous false confidence. This one is more insidious. It's not about miscalculating your costs, it's about being wildly optimistic about your assets. It's the difference between misreading the price on the menu and thinking you have way more money in your wallet than you actually do. It often starts with a big round number. People see $1 million, $2 million, $5 million in their portfolio and think, I'm set. They assume their savings will last longer than realistic withdrawal rates will allow. They hear the 4% rule, but they don't understand the fine print that underpins it. The biggest piece of fine print they miss is something called sequence of returns risk. It's a technical term for a very simple but very cruel piece of bad luck. It means that a bad market in the first few years of your retirement can do exponentially more damage to your portfolio than a bad market when you're 15 years in. Imagine trying to launch your boat. Launching on a calm day is very easy, but launching into the teeth of a hurricane, you'll sink it before you even get out of the harbor. A bear market in your first 2 years of retirement is that exact hurricane. People also overestimate their investment returns, leading to unsustainable spending. They assume the 12% annual returns they saw during the bull market will continue indefinitely. That's like assuming that because you had green lights all the way to work one day, you'll never hit a red light again. It's not a plan, it's very wishful thinking. I've seen heartbreaking cases where many retirees thought $500,000 would last 20 years, but they faced depletion just 12 to 15 years into their retirement. So why does savings overestimation prove more dangerous than simply not saving enough? Because false confidence will prevent contingency planning. You don't prepare for a storm if you're convinced the sun's always going to shine. This overestimation leads to lifestyle choices that quickly become unsustainable. Buying that second home, taking the lavish trips, or maybe helping adult children just a little too much. And the worst part? Discovering your savings are inadequate after you're already retired leaves you with very limited options. Your skills may no longer be current. Ageism is a real thing, and the job you left, well, it might not be there anymore. But this next mistake is the one that surprises people the most. It has nothing to do with market returns or inflation. It's the purpose and boredom crisis. For 30 to 40 years, your life has had structure. You were a CEO, you were a doctor, an engineer, a partner. You solved problems, you managed terms, you had a place to be at and a reason to be there. Then on Monday morning, you wake up and all of that is gone. People wildly underestimate the psychological impact of losing their work identity and their purpose. That question, so what do you do, becomes surprisingly difficult to answer. The initial honeymoon phase, the sleeping in, the playing golf, the catching up on projects is fantastic, but it will typically only last from 6 to 12 months before a new reality sets in. When people discover that unlimited free time often becomes overwhelming rather than liberating, it's like being given a blank book and told to write a masterpiece. The sheer emptiness of the pages can be paralyzing. Because as human beings, we're hardwired for basically three things. We want structure, we want purpose, and we want social connection. Work, for all of its faults, provides all three. And when you remove it without a plan to replace it, you create a giant vacuum. This is not a theoretical problem. It is very real, and many retirees end up returning to work, not for the money, but for the psychological well-being. Now that you know how not planning can actually lead to a retirement crisis, if you feel like you need more personalized advice, head down to the description after watching the video and book a call where I'll look at your specific situation and show you how to plan your ideal retirement. And this brings us to the root cause of all these issues. All the regrets we've discussed, the financial shortfalls, the boredom, the disappointment, are all symptoms of a deeper problem because all of these mistakes are avoidable with proper planning. First, retirees focused almost exclusively on an accumulation number rather than a comprehensive lifestyle planning. For decades, the goal is simple: hit X million dollars, whatever it is. But they never have stopped to ask the more important question: what will I do all day? How will I structure my time? Who will I spend it with? How will I stay mentally and physically engaged? They spend 40 years climbing the mountain, but never plan what they'll do with the view at the top. Second, they fail to test the retirement lifestyle before making a permanent decision to leave work. You wouldn't buy $1 million house without walking through it first. Well, at least I hope you wouldn't. Yet, people will commit to a 30-year multi-million-dollar retirement without ever taking it for a test drive. Third, as we discussed, inadequate healthcare planning creates a massive unexpected expense that can cripple your plan. They plan for investments, but not for any insurance. And finally, poor timing with market conditions can absolutely devastate early retirement plans. Retiring on the eve of a major market downturn is that launching a boat in a hurricane moment. A proper plan has buffers and strategies to help mitigate this risk. Now, why do these planning mistakes prove more devastating than just having an insufficient amount of money? Because planning failures are harder to correct than simple saving shortfalls. If you're just short on money, you can adjust your spending. But if you have a fundamental flaw in your lifestyle plan, no amount of money is going to fix that. Lifestyle and psychological mistakes affect your overall life satisfaction in a way that a slightly smaller budget doesn't do it. And ultimately, poor planning often requires returning to work under far worse circumstances than if you had simply stayed for just a few years longer. The bottom line is this: comprehensive planning prevents almost all of the common causes of early retirement regret. Now that you understand these planning mistakes, let's take a look at how you can achieve a successful early retirement without that regret. We've talked about the problem, now let's talk about the cure. This is how you join the 43% who don't have regrets. First, you begin with a conservative financial planning that accounts for higher costs and lower returns. You stress test your plan. What happens if inflation stays high for 5 years? What happens if the market drops 30% in my first 2 years of retirement? A solid plan will survive contact when reality hits. Second, you absolutely must stress test your retirement lifestyle through an extended vacation or even a sabbatical. Take a 3-month leave of absence if you can. See what it actually feels like. Do you and your spouse drive each other crazy now that you're home together? Do you run out of things to do by week 3? This is an invaluable real-world data. And I completely understand this is not an option for all of you. But if it is, take advantage of it. Third, be proactive. Develop purpose-driven activities and social connections that will replace the meaning you got out of work. Don't wait until you're retired to find a hobby. Start volunteering, join a board, take a class, or plan a business that you can run on your own once you retire. And fourth, plan your healthcare coverage and costs comprehensively and include long-term care insurance in that plan. Talk to a specialist. Understand the options on the private market and the real costs that are involved. This cannot be an afterthought, and you cannot wait until you retire to do it. So what ensures your early retirement creates satisfaction rather than joining the 57% with regret? Well, it really does come down to this. You build larger financial cushions than the minimum requirements to handle the unexpected. This is how you sleep at night. You don't retire knowing that you barely have enough to pull it off. you build in some margin. You create structured activities and commitments that provide purpose and social interaction. Your weekly golf game, your monthly volunteer work, your quarterly board meetings, these become the new scaffolding to your life. You maintain the flexibility to return to work part-time if you want to, without viewing it as some sort of failure. Maybe you consult 10 hours a week. It keeps you sharp and connected and brings in some extra income. It is not a failure. It's smart, flexible planning. And most importantly, you focus on the comprehensive life planning, not just financial accumulation for your retirement. Now that you understand why 57% of retirees regret retiring too early and the specific mistakes that create this devastating outcome, you can plan your early retirement to achieve satisfaction rather than regret. It's not about working forever. It's about retiring well. The real goal is to ensure the next 30 years are rewarding, meaningful, and secure as the decades you spent building your career. If you'd like help creating a comprehensive early retirement plan that avoids regret and builds lasting confidence, click the link in the description to book a complimentary discovery call. In that call, we'll walk through your unique situation and map out a clear path toward the retirement that you've envisioned. Thank you so much for watching this video, and I look forward to seeing you on the next one. Cheers.